We begin today's deep dive with the bond market sitting at a genuinely precarious crossroads. U.S. Treasury yields are steady this morning, with the 10-year note at 4.53% and the 5-year at 4.26%, as traders attempt to balance two competing forces simultaneously: incoming inflation data that could reshape Fed rate expectations and escalating Middle East tensions following confirmed U.S. military strikes in Iran. The VIX has compressed to 21.36, suggesting equity markets are not in full panic mode. But make no mistake, the calm on the surface masks significant uncertainty running underneath today's tape. Here are the hard numbers. The 10-year Treasury yield is sitting at 4.53%, essentially unchanged on the session, while the 5-year yield holds at 4.26%. Markets are showing mixed signals as investors digest both the inflation outlook and geopolitical developments. The VIX at 21.36 reflects measured pricing of risk. The dollar index and commodity markets are showing notable divergences, with gold pulling back as investors remain cautiously positioned ahead of critical economic data. The deeper story here is that the Federal Reserve is standing at a policy inflection point, and this week's CPI data could fundamentally shift the trajectory of rate expectations. Markets have been operating under the assumption that inflation is moderating, but moderating is not the same as defeated. The FOMC has made clear it is scrutinizing core readings with particular intensity, and any upside surprise could obliterate the rate cut narrative that has quietly re-entered consensus thinking. Meanwhile, the Iran strikes introduce a genuine energy supply risk premium that complicates the Fed's calculus further, because oil-driven inflation is exactly the kind of exogenous shock that makes the central bank's path dramatically harder to communicate with confidence. Let's map out exactly who gets hit and who benefits depending on how this resolves. Duration-heavy bond ETFs like long-term treasuries and TLH are the most binary trade in this setup. A hot inflation print sends them sharply lower as 10-year yields break higher, while a soft print would be a significant tailwind as real yields compress. On the equity side, the Nasdaq 100 reflects conditional optimism, but megacap tech is acutely vulnerable to a yield spike above 4.65%. Energy via the energy sector and Chevron is a natural beneficiary of the geopolitical risk premium. Financials and the financial sector face genuine crosscurrents. Higher yields help net interest margins, but recession risk concerns create an offsetting drag on loan demand outlooks. There are three specific levels every macro trader needs to have locked in right now. First, 4.53% on the 10-year Treasury is your fulcrum. A clean break below 4.40% would signal a genuine easing bias is being priced and would accelerate flows into long-term treasuries and rate-sensitive growth. Conversely, a move above 4.65% risks steepening the curve in ways that pressure equity valuations across the board. Second, S&P 500 support is around 7,250. A hold there is constructive. Third, the CPI release is the single most important catalyst this week. Watch core components specifically, because headline volatility from energy is expected, and the Fed has explicitly said it will look through oil spikes unless they feed into services inflation. The bottom line is this: investors who position defensively ahead of the CPI print are making the right probabilistic bet in an environment where geopolitical tail risk is active and the inflation story is genuinely unresolved. If the data prints hot, 10-year yields above 4.65% would be a serious problem for the Nasdaq 100 and long-duration portfolios, and long-term treasuries would be the sharpest expression of that pain. If the data disappoints to the downside, long-term treasuries becomes a compelling beneficiary and tech rallies hard. Energy and defensives provide a reasonable hedge either way, given the geopolitical risk premium currently embedded in markets. That's the full picture on today's treasury and inflation setup. Coming up next, a story with direct implications for global equity valuations and investor positioning. Shifting now from markets to the consumer engine underneath them, and the signal coming out of the New York Fed this morning is one of the most important data points we've seen in months. The New York Fed's monthly household survey revealed that financial worry sentiment has climbed to its highest level since. That is not a trivial comparison. Was the peak of post-pandemic inflation anxiety, a moment when households were being crushed by surging prices across every category. The fact that worry has returned to that same threshold today, in a very different inflation environment, tells you something structurally significant is happening beneath the surface of this economy. Here are the specifics. The New York Fed's June survey recorded household financial worry sentiment at its highest reading since. The prior month's survey, the May 2026 reading, showed elevated but lower levels of concern, and consensus expectations heading into this release were for either flat or modest improvement, given that headline inflation has been broadly stable. Instead, the survey delivered a deterioration that broke above the prior peak. What makes this particularly striking is the disconnect. Inflation expectations in the same survey remained largely stable. Households are not worried about prices rising faster. They are worried about something else entirely, and that distinction is critical for how markets should interpret this data. The reason this reading carries significant macro impact is precisely because of that inflation disconnect. When worry rises alongside inflation expectations, the Fed has a clear framework: tighten until inflation breaks. But when worry rises while inflation stays anchored, the transmission mechanism becomes murky and more dangerous. What is driving the stress? The three leading candidates are labor market softening, tightening credit conditions for households, and real wage dynamics, meaning even if nominal wages are holding, purchasing power erosion or debt service burdens are grinding down felt financial security. This is the definition of structural consumer pain, not a cyclical blip that one strong payrolls number can wash away. Let's map this directly to the tickers. The S&P 500 and the Nasdaq 100 are both holding gains this morning, but the household stress narrative is a latent headwind. Consumer discretionary faces the most direct exposure. If financial anxiety translates into pullback on non-essential spending, discretionary revenues compress first. Long-term treasuries, the long-duration Treasury ETF, is the natural flight to safety beneficiary. Deteriorating consumer confidence historically pulls yields lower. The 10-year is already at 4.53% today, down 0.26%. Meanwhile, healthcare and other defensive sectors become relative outperformers as risk rotation away from cyclicals accelerates on this kind of sentiment data. 3 levels and 2 catalysts define the near-term setup. On yields, the 10-year at 4.53%. Watch for a break below 4.40%. If household stress data continues intensifying and is confirmed by upcoming retail sales or consumer confidence prints, that yield breaks lower and long-term treasuries rallies hard. On volatility, the VIX is at 21.36 today, which means markets are not yet pricing panic. But 25 is the threshold that historically signals genuine institutional stress hedging. On the index, the S&P 500 at 7,289 has psychological support at 7,200. Treasury yields at intermediate levels are also worth watching. Compression in yield curves would confirm markets are pricing near-term Fed easing as the response to structural consumer weakness. Here is the single takeaway that matters for your positioning. Household financial worry at levels, decoupled from inflation expectations, signals that consumer pain is structural, rooted in labor market dynamics, credit conditions, or real income erosion, not in the price spiral the Fed spent years fighting. That forces a dilemma. The Fed cannot justify cuts purely on inflation progress if inflation is stable, but it cannot ignore deteriorating real financial conditions without risking a deeper consumer pullback that eventually breaks growth. Watch this data series closely as a potential catalyst for repricing rate cut timelines. Those are the 2 stories that matter most today. Full breakdown is right here. If this level of analysis is what you want every single trading day, hit subscribe right now and tap the notification bell. We break down every major market-moving story with the depth and specificity you need to actually trade it. Not just headlines, but levels, tickers, catalysts, and the macro context that ties it all together. New video every market day. Subscribe, and we will see you tomorrow.